All right, first up, look at the Asian markets. They're not doing too well. The Nikkei is straight off the bat down about a percent, and this is after Federal Reserve has hiked rates for the fourth time in 2018. Not just that, in fact, they've also said that in 2019, if need be, there will be more rate hikes. They've increased their federal funds rate target from 2.25 to 2.5. So all of that taking a beating on all the other Asian indices, all the markets of the world actually. As we speak, the Korean index lower by about 0.5% as well. And then we have the Straits as well as the Taiwanese indices, both of them sitting in the red. Most importantly for us, though, SGX Nifty was within kissing distance of the 11,000 mark yesterday. The street was wondering whether we go ahead and cross that mark or not, given the sort of positioning that there is high open interest in terms of 11,000 calls. But today it looks like straight off the bat we're down about 100 points at the open, sub 10,900. Let's see whether we find some support at lower levels and perhaps make another dash towards that 11,000 mark.
Okay, but the big cue from overnight is the Federal Reserve hiking rates by 25 basis points while lowering the median forecast for rate hikes in 2019 to 2 hikes from 3 hikes earlier. But the Fed has maintained the view to tighten its balance sheet, and that means lower liquidity for the markets. CNBC's Steve Leisman is here with a detailed report.
The market appeared to want total capitulation from the Federal Reserve on the issue of rate hikes next year. Instead, it got, call it partial capitulation at best. One example is the market wanted 1 or no hikes forecast for next year. Instead, the Fed continues to forecast 2 hikes. It wanted the removal of that phrase, further gradual increases. Instead, the Fed now says there will be some further gradual increases. I'm going to get to that detail in just a second. But first, I want you to hear Jay Powell talking about the change in the rates outlook.
Many FOMC participants had expected that economic conditions would likely call for about 3 more rate increases in 2019. We have brought that down a bit and now think it is more likely that the economy will grow in a way that will call for 2 interest rate increases over the course of next year. We always emphasize that our policy decisions are not on a preset course and will change if incoming data materially change the outlook.
Now, what the market wanted was just the 1 rate hike. Instead, now there's going to be 2. The market wanted some flexibility on the issue of the balance sheet and reducing that. Instead, Powell said, no, we're going to be pretty much full steam ahead on that plan to reduce the balance sheet by $600 billion. And it wanted just overall more concern about the economy. Instead, it got that line that we're kind of monitoring financial and global developments. But Powell may have been a bit more dovish than the market may have given him credit for. Listen to this one thing he said about the outlook for data.
I think from this point forward, we're going to be letting the data speak to us and inform the outlook and inform our understanding of what would be appropriate policy. So there's a fairly high degree of uncertainty about both the path and the ultimate destination of any further increases.
So really what that amounts to is that if the data don't prove the Fed right on the 2.5% growth next year, on unemployment remaining low, on inflation remaining near target, the Fed is not going to hike. So the market can be concerned if it wants with a forecast, but I think Powell just laid out a somewhat different reality for what he expects to actually happen.
All right, so what are the experts making of this move by the Fed? Let's invite Richard Harris, Chief Executive at Port Shelter Investment Management, who joins us on the phone line. Richard, thanks a lot for joining in. A rate hike which was on the cards, a rate hike did come by. The street was expecting 1 more hike for next year. Fed has gone ahead and said they'll do 2. While they've cut it down from 3, it's still 1 more than what the street would like?
Yeah, well, I think, I mean, this whole idea of 1 rate hike next year has sort of come in overnight. I don't think that's really a realistic proposition. The Fed was looking at 3. It does look as if 2 is much more on the cards. Yeah, 1 is possible. I mean, I think Powell has really laid his cards on the table and said, you know, it depends on data. We're looking at data, and we're going to make our decisions based on data. My general feeling is that the Fed really didn't have much of an option at this stage. You know, if they had not cut, if they'd not increased rates, they probably would have been in a position of, you know, being accused of being overly cautious about the economy. The markets would have taken that badly. So they're in a bit of a hiding to nothing, and I think keeping the course steady was the right thing to do.
Okay, so keeping the course steady was the right thing to do. But Richard, what do you make of the tone of the, of the Fed? Because Steve, our reporter, was telling us that maybe his comments were more dovish than what the street gave him credit for. Was it dovish enough for you?
I think that for me, he's hit it right on the target. Of course, we never know quite what the market thinks, but I think the Fed is obviously in the spotlight, as often they are, but they're in the spotlight, of course, because of Trump. But I think there's no doubt, and the market's showing it at the moment, that economic growth has eased. The gallop that we were looking at has maybe come back to more of a canter. And what the markets are concerned is growth on growth. And if the growth of growth seems to be slowing, then I think that's a concern, and that's really why markets have come off. But the Fed doesn't seem to be overly concerned at the moment about the overall picture.
All right, so you did allude to the fact that the markets have come off, Richard. In that case, a 52-week low for all the three frontline indices on Wall Street. We're not doing too well on the emerging markets except for India. What would your pecking order be? Would you put more money into America, or perhaps bring some of it to India?
Well, I've been overweight the States, and as the market's gone up, I've just let my holdings go more and more. So I am taking some cash out of the States, and obviously it's year-end, so one doesn't want to be have the positions too heavy sort of at year-end. But I have been taking cash out of the States, but only because I'm overweight anyway, and I'm really looking to rebalance, towards year-end. I think the thing about that hasn't really come through in the markets, and they haven't really started talking about yet, is the oil price dividend. We've seen, since mid-October, we've seen oil come down $20. That's from 85 to 65 so $30, 85 to 55 on Brent. That's an enormous move in any kind of asset over essentially 2 months. And I think that, countries and companies that are sensitive to the oil price, this is obviously going to be a little bit of a Christmas present.
Okay, so the decline in crude price can be a Christmas gift for economies like India, which are the crude importers. Thank you, Richard, for joining us and making sense of the entire Fed decision as well as the global economic setup. But let's move on and talk about how the Wall Street reacted to this. Now, it was another very volatile session with the Dow swinging nearly 900 points before ending 350 points lower, which is its lowest level so far this year. The S&P 500 too finished at 2018 lows, ending 1.5% lower, while the Nasdaq plunged over 2%, led lower by shares like Apple and Facebook. CNBC's Josh Lipton gets us a wrap of all that transpired on Wall Street yesterday.
Big reversal in the U.S. markets after the Fed announced its latest decision on interest rates. The Dow falling 351 points. It was up more than 380 points before that Fed announcement. The S&P off 39 and the Nasdaq down 147. The Federal Reserve raising its benchmark interest rate 1/4 point for the 4th time this year, despite President Donald Trump's criticism against rate hikes. The benchmark rate is now between 2.25 and 2.5%. The Fed lowering its 2019 forecast from 3 rate hikes to just 2, but also warning that further gradual rate hikes are still needed. Meanwhile, shares of Facebook getting hammered today after the company said in a blog that it let other big companies like Netflix, Spotify, and Microsoft read users' private messages. The blog is in response to a New York Times investigation. The spokespeople for some of those companies did tell the Times they were unaware of the broad powers Facebook granted them. And drug maker GlaxoSmithKline splitting into 2 businesses after forming a new joint venture with Pfizer's consumer health division. GlaxoSmithKline will have 1 business for prescription drugs and vaccines and a 2nd business for over-the-counter products. That's the action from the U.S. market. Now back to you in Mumbai.
Okay, on that note, here is some opinion coming in from experts on what they make of the Fed decision as well as the road ahead for the U.S. markets.
The Fed is really in a sweet spot right now. Growth is good, unemployment is very low at 3.7%, and they are roughly at their target of 2% inflation. So what could be better? They have to continue on their path of taking away the accommodation and get into a neutral stance, and that's exactly what they did. I think the Fed did essentially the right thing today. I think I think actually investors should feel comforted that they've got such a prudent, patient Federal Reserve. Real interest rates are still basically zero. And the way you prolong an expansion is you avoid asset bubbles. That's been what's killed expansions for the last 25 years. I think Jay Powell is doing the best he can. I'm really glad the Federal Reserve did this. I think it helps prolong the expansion.
I think eventually we'll get to that one hike next year, but it's going to be very slow on an institutional basis. The Fed projects first and then acts. It's a nervous market. You've got people doing tax loss selling right now. So you have a selling bias going into this, particularly because pretty much every buy since October 1 was a bad buy. You have people selling for tax reasons. And I think it's just going to be a tough market till the end of the year.
All right, then, across the Atlantic, in Europe, markets ended higher for a couple of reasons. One, while they were awaiting the Fed rate decision coming in, there was a deal between the Italian government as well as the European Union. They reached a breakthrough on 2019 budget plans, which is why the FTSE MIB Italy, that index was high by 1.6%, top of the chart as far as the Eurozone is concerned. And that's because the Italian Union have agreed to a budget deficit target of 2.04%. This compares with an initial budget deficit target of 2.4%. So that's positive for the Italian banks. The British index outperformed for a couple of reasons. One, the Britain's inflation, that fell to a 20-month low in November. Apart from that, we had the GSK deal come by, and that stock too was higher by about 4.5%. So good going for the Italian markets as well as the European markets. Let's see how they fare in today's trading session after the Fed rate hike was announced.
Okay, let's see the impact of the Fed rate decision on the equity markets. But in the currency space, the dollar has recovered from lows after the Federal Reserve's guidance on its tightening cycle was less dovish than what people expected, even though it does forecast fewer interest rate hikes than it had in September. The dollar back above the 97 mark.
In the world of commodities, crude oil prices rebound from multi-month lows but remain under pressure from oversupply concerns. Also worried of a slowing global economy that would depress demand for fuel, which could also weigh on sentiment.
Okay, on that note, let's slip into a quick break. Come back, we'll tell you all the cues and news that are lined up for the day.